This is the free cash flow yield for 3 different companies. But how do you know which companies have a good number and which companies have a bad number? In this video, you're gonna learn everything you need to know about the free cash flow yield, including what this number is, how do you calculate this number, how do you use this number to make investment decisions, and if you stay until the end of the video, I'm even gonna show you how it is that you can get the free cash flow yield automatically calculated for a whole bunch of companies at once. There are 2 different formulas used to calculate the free cash flow yield of a company. The first and the most typical is to take the free cash flow and divide it by the company's market capitalization. The second formula, which is also used, is to take the free cash flow of the company and divide it by the enterprise value of the company. I personally recommend using the first option because this is the one that is most commonly used, and this is the one that I believe provides you with some really good insights that you can use for your investment journey. To calculate the free cash flow yield for a company like Whitesheets, we can use an extension like the one that you're seeing from Whitesheets to get the company's financial statements, which we will need this information to perform the calculation. One of the things that we need first is to get the free cash flow. So as you can see, if we go to the cash flow tab, we can see what the free cash flow is, and we can see this number over time. And then the other number that we need is the market capitalization. If you navigate right here to the key metrics, you will see the market capitalization, and you can see that this market capitalization is taken at the time when the financial statements were released. So to calculate the free cash flow yield, all we need to do is take the free cash flow and then divide it by the company's market capitalization, which we can see right here. We can also apply the other calculation that I mentioned to you, and the only difference is that we would just divide it by the enterprise value, which is also available in the key metrics that you can see right here. Now going back, usually this number is expressed as a percentage, so this is something that we would see. This means that for Apple, for every $100 that you currently invest in the company is able to generate roughly $3.69 back in free cash flow. Now, generally, the higher the free cash flow yield of a company, the better. But there's one key thing that you need to know that is going to allow you to avoid investment mistakes. Before we get into that, let me show you the 2 different ways that we can use to assess whether or not the free cash flow yield of a company is good or bad. One way to find out would be to take the existing free cash flow yield and calculate this on a historical basis. This could be annually like we're doing right now, or this could be done on a quarterly basis. So as you can see, we just need to drag the function across. Now we get this number automatically calculated, and we can compare the current number with the historical number to see, are we buying Apple at a historically high free cash flow yield, or are we getting it at a good number? In this case, just the free cash flow yield itself, it seems to be at a reasonable number at this particular period of time. Another way is to take a list of similar companies that are in the same sector or industry and have similar market capitalization. So in this case, we're not doing it for Apple, but let's say that we were analyzing TSM. What we would do in that case is take a list of semiconductor stocks like we can see right now, and then calculate the free cash flow yield. Now, using Whitesheets, you can use this function that you're gonna see right now, and the very cool thing is that really, in order to compare the companies accurately, we need to get the free cash flow yield, but we don't need to get it for the last fiscal year. We want to get it for what we call TTM, which is essentially the free cash flow yield right now, and that is based on the free cash flow, which is taking the sum of the last 4 months, and that is based on the free cash flow for the past 4 quarters, as well as the market capitalization right now based on the current stock price. So this is the most accurate way of getting it. As you can see, once you have the number like this, we can turn it into a percentage, so that way we can visualize the information a lot easier. And then even better, what we could do is to select this information right here, go on insert, and create a graph that's going to allow us to visualize this information in a more clear way. So just based on this analysis, we can see TSM is right here and it seems to have a reasonable number compared to some of the competitors right here. We can see that some other ones have very high numbers, which you could think that is a good thing, but we're gonna get into why that may not be a good thing necessarily, whereas TSM seems to have a quite reasonable number. Now, going back to the mistake that you can make when you're making investment decisions based on the free cash flow yield is the fact that this metric doesn't necessarily reflect the quality of a company. You see, often what happens is that there's an inverse relationship between the free cash flow yield of the company and the quality of the company itself. So sometimes if the company's free cash flow yield looks really good, it may mean that the quality of the company itself is very low, which is why the number looks so good on paper. And of course, this is critical to avoid any investment mistakes, because if the company has a really good free cash flow yield, but the company quality is bad, meaning the company is not growing, the company doesn't have a good competitive advantage, etc., then that means that your investment is likely going to go down instead of up over the long term. So really what you want is a good balance between getting a good free cash flow yield, but at the same time getting it in a company that's of high quality and high value. Now, the great thing is that even if you pay a little bit high of a price in terms of the free cash flow yield ratio, is that if the company is consistently growing its free cash flow over time, then the free cash flow yield is going to look better and is going to be a good investment decision for you nonetheless. Now you know everything you need to know about the free cash flow yield. So if you've enjoyed this video, make sure to subscribe to the channel and I'll see you in the next one.